Hey everyone, welcome back to the channel. In today's video, we're going to dive deep into a question that many investors face. Should you invest in real estate or stocks? Both are popular investment options, and each has its own set of benefits, risks, and rewards. The real question is, which one is better for you? If you're someone who's considering building wealth and securing your financial future, this video will give you a breakdown of both investment avenues and help you decide which one aligns with your goals, risk tolerance, and preferences. So, let's get started. What's the difference between real estate and stocks? Before we jump into the pros and cons of each, let's first understand what makes real estate and stocks different. Real estate. Investing in real estate means buying physical property, residential, commercial, or land, and earning money through rental income or capital appreciation, selling the property for more than what you paid. Real estate is a tangible asset that you can see, touch, and even live in. It's considered a relatively stable long-term investment. Stocks. Investing in stocks means buying shares in publicly traded companies. You own a piece of the company, and as the company grows and profits, so does the value of your shares. Stocks can be volatile in the short term, but they also offer the potential for high returns over time, especially if you invest in growth stocks or index funds. Now that we know the basics, let's break down the key factors to help you make an informed decision. 1. Potential for returns. When it comes to making money, both real estate and stocks offer opportunities for strong returns. But there are differences in how those returns come about. Real estate returns. Rental income. Real estate investors can earn passive income through rental properties. If you invest in residential properties, tenants pay you monthly rent, providing a steady income stream. Appreciation. Over time, real estate properties typically increase in value. However, the rate of appreciation depends on factors like the local market, economic conditions, and the condition of the property itself. Leverage. One of the biggest advantages of real estate is the ability to use leverage, meaning you can buy a property with a relatively small down payment and use financing, like a mortgage, for the rest. This allows you to control a large asset with less capital upfront, increasing the potential for higher returns on investment. Stocks returns. Capital gains. The main way investors earn returns in the stock market is through capital gains. This means the price of the stock increases over time and you sell it for a profit. Dividends. Many established companies pay dividends to their shareholders as a way of sharing profits. Dividends can be reinvested to buy more shares, which can compound your returns over time. Growth potential. Stocks, especially in high-growth sectors, can offer significant returns, sometimes higher than real estate, especially in the long term. Stocks in technology, healthcare, or green energy, for example, can experience explosive growth. Conclusion on returns. Real estate offers more steady, predictable returns, especially through rental income. Stocks, however, have the potential for higher returns but can be more volatile. It ultimately depends on your risk tolerance and the type of investment strategy you follow. 2. Risk factors. Understanding risk is crucial when deciding where to invest your money. Both real estate and stocks come with risks, but they vary in nature. Real estate risks. Market fluctuations. Real estate markets can be cyclical. If you buy at the wrong time or in an area that's experiencing a downturn, you might see your property's value decrease. Liquidity issues. Real estate isn't a liquid asset, meaning you can't quickly sell a property to access cash if needed. It can take weeks or months to sell, and there are closing costs involved. Management costs. Owning property requires ongoing maintenance, repairs, and potentially paying property management fees if you don't want to manage it yourself. These costs can eat into your profits. Tenant issues. If you're investing in rental properties, dealing with tenants can be stressful. Non-paying tenants, property damage, or vacancies can affect your income. Stocks risks. Market volatility. The stock market can be unpredictable in the short term. Prices can fluctuate drastically based on company performance, industry changes, or broader economic conditions. Economic factors. Stock prices can be significantly impacted by factors like interest rates, inflation, and geopolitical events. This can result in significant losses, especially in the short term. Individual stock risk. Investing in individual stocks can be risky. A single company's poor performance can lead to a decrease in the value of your investment. That's why diversification is key to managing risk. Conclusion on risk. Real estate is generally considered less volatile in the short term, but can present challenges in terms of liquidity and management. Stocks can be more volatile but offer higher liquidity, meaning you can buy and sell more easily. 3. Effort and time commitment. One of the big differences between real estate and stocks is the time and effort required to manage each investment. Real estate commitment. Active management. If you're managing rental properties, expect to invest a significant amount of time in property upkeep, finding tenants, handling maintenance issues, and dealing with finances. Long-term involvement. Real estate is a long-term game. Buying and selling property takes time, and the rental income builds slowly but surely. Skill development. Real estate investing requires learning about property markets, property management, legal requirements, and financing options. It can take time to develop these skills. Stocks commitment. Passive investment. Once you've set up your stock portfolio, whether it's through individual stocks, index funds, or ETFs, the amount of time you need to spend managing it is minimal. You can monitor your investments, but you don't need to be as hands-on as with real estate. Research. If you're investing in individual stocks, you'll need to spend time researching companies, their financial health, and market trends. But if you're investing in ETFs or mutual funds, you can make fewer decisions and leave the research to fund managers. Automatic investing. With stocks, you can set up automatic investment plans and let your investments grow passively. There's much less day-to-day involvement compared to real estate. Conclusion on effort and time. If you want a more hands-off approach to investing, stocks are likely a better fit. Real estate requires more time and effort, especially if you're managing properties yourself, but it can be more rewarding in terms of passive income. 4. Diversification and flexibility. Both real estate and stocks offer ways to diversify your portfolio, but in different ways. Real estate diversification. Real estate investments are often location-specific. It's harder to diversify within the real estate market unless you have the capital to buy multiple properties in different locations or types of real estate, residential, commercial, etc. Real estate can be a good way to diversify if you already have a stock portfolio, offering an asset that behaves differently from stocks. Stocks diversification. The stock market is inherently more diversified. You can buy shares in hundreds, if not thousands, of companies around the world. With just a few ETFs or index funds, you can have exposure to many sectors, industries, and countries. Stocks are much more liquid, meaning you can easily sell and buy different investments to adjust your portfolio. Conclusion on diversification. Stocks provide greater flexibility and diversification, while real estate is more limited in this regard, unless you have significant capital. 5. Tax implications. Real estate. Real estate investors can take advantage of tax deductions on mortgage interest, property taxes, and maintenance expenses. Additionally, real estate profits from long-term capital gains may be taxed at a lower rate than regular income. Rental income is taxable, but there are ways to reduce the taxable income by writing off expenses related to property management and maintenance. Stocks. Stocks are subject to capital gains tax when you sell for a profit. The rate varies based on how long you hold the stock. Short-term capital gains are taxed at a higher rate than long-term capital gains. Dividends from stocks are also taxable, but tax rates on qualified dividends are generally lower than regular income. Conclusion on taxes: both investments have tax advantages, but they differ in how they are taxed. If you're looking for tax deductions and long-term appreciation, real estate may be the way to go. For more straightforward capital gains, stocks are simpler. Conclusion: which should you choose? Ultimately, the decision between real estate and stocks depends on your personal financial situation, risk tolerance, and investment goals. If you're looking for hands-on involvement, rental income, and a more stable long-term investment, real estate could be a better fit. If you prefer a more passive investment, want the potential for high returns with more flexibility, and are comfortable with market volatility, stocks might be the way to go. If you can, consider diversifying. Invest in both real estate and stocks to balance out your portfolio. Let me know in the comments what you think. Are you team real estate or team stocks? Don't forget to like, subscribe, and share this video with anyone who's trying to decide where to invest. Thanks for watching, and I'll see you in the next one.